Reversals and breakouts, two completely different things. So a reversal is when we have price rallying in a direction. Something happens, price moves down, and we identify an area where we believe that price is going to reverse, right? So we say that price is going to reverse in this level, price comes back up into here, we get short and we expect it to go down, right? This is a reversal. And typically when we're looking for opportunities, we're used to looking for reversals. I know I've taught thousands of people how to look for reversals in the market, because reversals are typically where you find your highest reward to risk ratio trades, because you're going to be further out on the supply and demand curve, if you will. But when we're looking for breakouts, a breakout is where we see price break out violently one direction or the other, and we see bigger moves. So those moves, there's got to be some rules around it. So reversal trading is where we're trading a little bit of price changing direction. Breakout trading is where we see that price tends to break away from an established area. And we're buying here. Now, what's the problem with this? Here's what we've been taught, and I know I've taught it to people as well. The two biggest mistakes most people make as investors is, mistake number one is that they buy after price goes up, right? So they typically will buy after price goes up. Now, is this after price goes up? Absolutely it is, because price has already risen. That's one of the biggest mistakes a lot of people make. And so when you get caught with breakouts, doing them the wrong way, it's because you are ignoring this rule, but also ignoring this one. They buy where there are more sellers than buyers. See, it's one thing to buy after a rally up if there's no sellers up here to stop you. See, what we want to look for are breakout opportunities where there's no sellers to stop us from going higher. And so there's specific criteria that I look for. And the reversal trading is still the foundation that makes a breakout trade work. The reversal trading is the foundation that makes breakout trades effective. So you have to have good reversals before you can have good breakouts. Remember that. You have to have good reversals before you can have good breakouts. When I look for trades, when I look for positions in a client's account, what I'm looking for are where are the breakout potentials that have been reversals in the past, because those become psychological areas that will repeat over and over again. So here's really what I'm looking for. The two criteria, the most important criteria. Number one, keep this in mind. If you're going to have a breakout rule, number one is, most important thing, room to roam. You got to give it room to roam. It's got to be able to move. You can't have a breakout where there's no room to roam. And what I mean by that is, let's say that I have price doing something like this. And then we hit this area where we seem to have this topping. Now, this would look like a good opportunity for a breakout. And a lot of traders, especially when they first start out and they start reading books, and a lot of investors, they will buy a breakout right here. And they'll buy this right here because they'll see, and they'll just call this traditional resistance, and price is broken through resistance, so they're buying. Well, what's the problem with that? I got no room to roam. And I have no room to roam because up here, I'm going to have a bunch of sellers. Up here, I'm going to have a bunch of sellers. Here, I'm still going to have sellers. And all of those sellers are going to act as, think of it like thick soup, right? Think of it like trying to stir thick soup. All these guys are going to act like soup that's going to slow price from getting to its area. And that's where you get what's commonly called as a false breakout. And a false breakout is where you have price breaking out and then falling through. And that's where people get killed on breakouts, because they don't look for room to roam. So the most important thing is, do I have room to roam? The second thing is that I want to be able to see where prior reversals have played into the current position. So prior reversals play into the current position. So that's rule number 2. Okay, so prior reversals play into this breakout. Your reversal is always going to be your highest reward to risk because you're going to be further out on that supply and demand imbalance. You're going to be buying much, much lower. You're going to be selling much, much higher. But you're also going to have a higher loss percentage. Your win-loss percentage is going to be lower, but your reward to risk will be greater, and that's okay. So if you want to increase that reward to risk ratio, increase that win-loss ratio, then what you can do is look for breakouts around prior reversal areas. And I will oftentimes, and this is kind of why I've been doing the daily market commentary on the YouTube channel, for those of you that have been watching it, I try to leave the lines on even sometimes when a level's been broken. And the reason that we leave the line on is because that level still has validity going forward. The orders that created the reversal no longer exist. Remember that. The orders that created the level no longer exist, but there are still going to be people that are pumping in orders in there. So think about something like this. So I'm going to erase these rules so I have room to draw, and then I'm going to go look at some charts here in a minute. I know this is a very high-tech presentation board in our extra bedroom. So this is where let's say we have something that looks like this, where price is rallying up and it starts to find a balance, a fair price area. And a fair price area is when buyers and sellers have come to agree that there's a fair balance of price. And price then decides to move away from this fair price area. Well, in this area, which was a fair price area, if you think about this range of price, there was a certain number of buyers and a certain number of sellers that created this fair price area. So the number of buyers and number of sellers, price went up because nobody else in this level was willing to be a seller at this low price point. Basic supply and demand 101, right? There was nobody else down here who was willing to sell at this low price, so price went up in search of more sellers. Now, price comes back down, and this is a traditional reversal. It runs into the buyers and it heads back up. But as it comes down, what it's doing is, as prices are falling, what's happening is more and more people that are trend following are getting excited about selling. So what happens is you do start to pick up more sellers, and it runs into this pile of buyers. Now the buyers are going to start to reduce their numbers, but the sellers are going to start to gain their numbers, right? So let's say price comes back down into it, and we come in and we get a little bit deeper into this range, and we head back higher. And then the next time that we come back in, let's say that we pop out of it. Now, looking at this, here's what I see. We have buyers that are getting smaller in size, right? But my sellers continue to pile up. I'm getting more and more selling. But the other thing is, if you look down here, look at this move up into here. This was a strong move up into here. So this now becomes what I like to call a room to roam, right? So now we have prior reversals playing a part, and there's room to roam. So since there's room to roam, now is when I would be willing to get short on a breakdown out of this level. Now this is an area where price has hit in there a couple of times, but I'm okay to get short out of this. And I will tell you, yes, you can get short out of this and play it down, or you can just play the reversal and wait for price to retest. But how many times have you seen that you missed the trade because price doesn't retest? I'm sure that's never happened to any of you, right? No. So my point behind that is, when price comes back into the level, sure, you're going to get another opportunity if it comes back. And what I found, and part of the reason why we started doing these daily market, recaps, if you will, was so that you could start to see every day the same markets, how they work. and what is the kind of step-by-step piece behind it. So I want to go pull up some charts on a couple of different positions. I'm not going to spend too long here. Pull up a couple of different charts on a couple of different positions and analyze them, and allow you to kind of see what I'm looking at and talk through my rules on the breakouts. Remember, room to roam, prior supply and demand, or prior pivots coming into play, okay? So here is, now this one has a couple of prior pivots that came into play. This is an hourly chart on the Great British Pound, and what we can see here is a very, very strong drop in price. Now that very strong drop in price is what tells me, okay, there's absolutely nothing really to stop it once it gets above this level. Here I have a very nice pivot and a very nice reversal. We get another one right here. Now, a lot of traders would call this a double top, right? M for murder, that's kind of what I learned, right? M for murder. I don't want to use that as the double top. I like the fact here that we came up and we based around in there for a while. So that means that that's a fair price area. We hit it again with another fair price area. And those areas of fair price where you have that balance between buyers and sellers means that you have a lot of people believing that this is a good place to transact. Your volume is going to be is in this area. You've got a lot more volume on those prices because that's where it occurred. Now, as price rallies up into here, in a perfect world, what I'll see is it base, 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 and then I can set some sort of a conditional entry to get long if it gets above this line. And that's the setup. Now, once I get in, my stop is going to be below the prior pivot as price came up. So if, let's say that we have something that looks like this. Let's say that price rallies up, we're basing here. Let's say we get this. All right, and now we break out. Here is my prior pivot. So my stop loss is going to have to go below the prior pivot. Sometimes that means that my stop loss will be down here, right? If we broke out there, then my stop loss would be further away. The stop loss, you can't just say that it's 2% it's 1 ATR below the level, or it's not 2% below. It's got to be below the prior pivot. You've got to give wiggle room, and the more parabolic the move is, the bigger wiggle room you need to do. Adjust your position size to fit your risk tolerances so that you don't catch out on the loss. Now, what you then do is look and see, well, this thing should at least get to here. Whatever my measurement of where I think it's going to go, that measurement takes 75% of it. So if I think it's going to get to here, let's take 75% of that, and that's where I'm going to place my primary target. Here's my risk. Here's my reward. That's the way we want to play these. You still have to follow your reward to risk rules. I will manage them oftentimes a bit tighter, and I'll move the stop a bit more frequently when looking at something like this. Okay, let's look at another one. One of them that's been very effective over the course of the last couple of months has been the Canadian dollar. I've been doing these daily market commentaries now for about 4 weeks, I think it's been, and this one has been one of the bigger ones. So let me do 90 days on an hourly chart. Okay, so the Canadian dollar right now, so this level that we have here, if you notice, we have the pivot, price comes up, pivot, 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 price comes up. I'm still waiting on price to come back down into here. Now, let's look at some other levels in here. Could this be considered a breakout right here? Right? Would I consider this a breakout? I've got a pivot, base, 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 drop away, base, 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 drop away, base, base, drop away. Could I consider this a breakout? Absolutely no. And the reason this is not a breakout is because it doesn't have rule number 1. There is no room to roam. There's not enough room for price to continue to rally. If I don't have room to roam, if I don't have an area where price can go, I'm not going to be interested in it. The thing I like about these positions is that I'm looking specifically for room to roam. So when I am pulling up any of these individual breakouts, That's exactly what I want to be looking for and finding. Here's one that I really like in the Aussie. Let me move this out to a daily chart and pull this back. Now, here's this one in the Aussie. Now, I'm doing this on the hourly chart. Here is an area which was another, could be another spot, right? Well, this doesn't look like it's very far away from here to here, but on an hourly chart, that becomes a pretty fair distance. So when I move this down to the 1 hour chart, if I can get, price comes into here, let's say we get something like this. If I've got a stop loss right here and a target right about there, then that would give me this small amount of risk for this much reward. And I have room to roam. That's really the key of what we're looking for when we do these breakouts on a day-to-day basis. Now, what I'm doing here is for trading. This is for my short-term traders, the people that I've worked with for years. I know a lot of you students by name, love you dearly. For my investors, the people that are looking for us to invest for them, we're still doing a lot of the same concepts, a lot of the same processes. We just do it on different time frame charts. See, this is a 1 hour chart, so we're looking at very small time frame moves. When I'm talking to somebody that's potentially looking to be an investor and they want us to manage their funds, we're going to look at something more like daily charts and specifically look for breakouts. Let me give you an example. Here's one. So here we have this area. This is one that I've been watching for a little bit. EAT. If you don't love the ticker symbol EAT, you got something wrong with you. No, it's Brinker International. It's Chili's. But they have a base, right? Base, break, base. I don't have the room to run here that I would like because of this little bit of area in here, but this is really just all this noise up there. I think that there's room for it to run at least up to this gap fill range. So for my investors, what I would look is more on a bigger time frame chart, and this is where I would, if somebody wanted to be a more active client and wanted us to manage for them, we would look and say, okay, well, we're still going to have an entry right here, we're still going to have a protection right here, and here's where we're going to have a target. And looking a little bit down the road of more technical on the price basis, but also what can it provide. Now, the other good side of this is this one pays, I think, about an 8% dividend yield. So if you do own the security, you're gaining the yield on top of it. So just remember that on breakouts. I'm gonna kind of cut this thing off here. I don't want to go too long. I just wanted to make sure that everybody understood some of the concepts. I think this is saved on the, I'll put this up on the YouTube channel so that it stays. If you have any questions, do me a favor, you can email me. You can, if you got questions, call our offices directly, 832-953-4998, or go to iifinancial.com and fill out a contact us form with your information, and I'll get back to you. So thanks so much, everybody. I hope you had a good night. Everybody be safe, and I will see you all soon. Bye.
Got part of my face. I didn't know how to stop it, so it showed.